long term, every year is growing, but within year, you can have seasonality as well, right? In particular, in the case of the target company, uh, and I would say seasonality is something you should discuss internally. And you have to judge what kind of business cycle and product cycle it is. And we will talk about it in the next few pages. Is the model sustainable? Is a high growth rate sustainable? Why talk about high growth rate? Obviously, you guys wanted to work on a company. Like it or not, you want to buy it. Or, okay, it's just share price gone up too much. You think there's a chance you want to short it. Okay. Third, likely, those companies get your attention because it has been or it is a high growth business. You have to ask yourself a question. Is the high growth rate stage already passed or potentially can persist? Identify the key growth drivers or variable of the business, and also that could be the key variables of your financial models. Okay, and we'll talk about it. Sometimes you may think about whether you should use one or multiple valuation approaches to value the firm. And this is possible that you show all your work of different valuation in one table to justify yourself. For sure, the number may not be the same, but as long as you justify yourself, it's all good. And most important of all is the whole team should believe in one single model. Okay. I mean, one single valuation approach. And obviously, we used to think about the worst and the best case scenario of the company. And the final point, bullet point is, does the management have a consistent strategies? This will the free cash flow back to the shareholders. Later on, we'll talk about you're going to use the free cash flow to equity as a key model. Sorry, free cash flow to the firm as a key model. But then in that case, the free cash flow will be keep discounting, but not factoring into the case like the dividend discount model. Okay, so the difference would be obviously, will they pay back the free cash flow? You assume they have the cash, but maybe they would like to keep reinvesting. They may do M&A, and cash flow would never go back to shareholders. And sometimes, depending on type of company and depending on the market conditions, that consistent payback strategies could make a big difference from a WACC perspective. So move on to it's not moving. Okay. The next few page, we just go through why the product cycle is so important. Because obviously, from my financial career, I've seen so many cases that the product, the company itself, the growth rate not grow in the extrapolate consistent growth rate. Very likely will be in a S curve. That means in the early stage will be a little bit flattish. Once think about like Tesla, okay, in the early stage, 15, 16, 17 is early stage of the company to grow, and then 17 to 2020 is super high growth. But once they're getting more competitors, you can imagine, while they're still growing, but the growth rates come down, okay? And the next year could be like in mid-20s, and afterward could be teens, okay? But the absolute shipment numbers could be still very high. So the thing is like, this sort of S curve is a very typical revenue model or product cycle model that you can factor into it. And obviously, if you look at, say, this is one of VC provided type of curve, because of the different stage of the product cycle, profitability, the lower left chart, which will be related, like the growth rate will be related to profitability. When the growth rate is actually getting slower, likely they are under higher competition, and they may have to cut the price to maintain the market share, and likely they will subject to margin squeeze and profitability may come down. Even though they ship more and more products, they're selling more and more to customers. So this is one of the cases your team should discuss on revenue growth cycle likely that the company has entered to be. And that will have a major impact on the potential PE of the firm, valuation of the firm. Normally, high growth company will enjoy high P multiple. Vis-a-vis lower growth, the product state cycle getting to be more mature, the multiple could be lower. Okay, that's it. So this is one of the showcase. Want to tell you is if you really using the Excel, which is very good to drag the same number all along to 10 years, and the difference between that approach, extrapolation approach, vis-a-vis a real case S-curve approach. The beginning point, the ending point are the same, but the trajectory of the curve are different. Then that will leading to a difference of around 10 to 15% of the revenue on an accumulated basis. And that could also leading to a big difference in your DCF model as well. Do you follow it? Okay. So obviously, if you work on even scenario analysis, this is the IEA provided chart, and IEA is International Energy Agency. Obviously, they enable. Anyway, obviously, they are providing different kind of forecasts of oil and gas and different kind of energy as well. You can see that based on different scenario, the oil price in 2040 could have a big range from $75 to $110. Obviously now it's around 80. A few months back it's around 100. So even though a very professional agents within their internal forecast, the difference could be dramatic. And like your firm, okay, could be subject to high competition. With team, you have some optimists, you have some pessimists. Okay, is it reasonable to expect that share price as a not well, even now big cap could be very highly volatile, right? Like Nvidia last year is $100 at the lowest, this year is 500. Wow. Scenario analysis, I would say could be a must. Okay, at the end of the day, this is only a workshop, gives you a bit more of our thought and sharing with you. You make your own final judgment call. But I want to take some of the workload of the mentors and make sure mentors try to guide you more on your way of thinking. We guide you more on the way to plan on your modeling. Okay, you can. We're happy to share the PowerPoint view. No need to take pictures, and some of the colleagues already recording as well. So I don't know why did somebody like draw some line here, same as yesterday. But anyway, so it's my Google Sheets anyway. So how's all these kind of major factors have any kind of impact on the valuation? I would say market is so important. The market size, the market growth rate, okay, and the phase of the cycle, as I mentioned, and obviously competition. Always ask these questions. Okay, Tesla is tip of the top, but doesn't mean they don't face any competition at all, right? So that will leading to set, first of all, like your DCF model, okay? You have to discuss within the team 3 years, 5 years, or 10 years. Later on, we discuss how to make a decision making. Your terminal market size and terminal market share as well. And that leading to could be a substantial change of the valuation because terminal value likely to be 40, 30, some cases 50% of the total valuation of the firm, excluding cash. Okay. And the small changes of just terminal value assumptions could leading to a big change of the valuation. and don't play around tricks because I will tell you how to justify your valuation. And obviously, once you set up the market, once you know the kind of market share, competition status, then you should think about whether we are still in a high growth phase and the potential pricing trend, and also are they going to launch new business model, because new business model could change the revenue profile picture, margin, and even profitability quite dramatically. And that leading to whether you can justify for higher P multiple or lower. And again, on terminal value in particular, the terminal value in terms of the margin and the growth rate. Margin trend is always something like a lot of investors are very focused on, because a lot of companies can maintain top line quite well. They may not drop it. Okay, for I just buy some new competitors. Okay, and keep the total revenue good. But because of competition, because we're entering into mature phase, when you get into terminal value, your margin may decline. So you may have to think about, obviously, this is more art and science. No one knows what's happening next 10 years, but you have to think and justify yourself. What is the stabilized margin level? I don't think they have gross margin, but then you think about operating margin and the margin. Tax rate, important, and also capital expenditure as well. Remember, regular business, if you need to maintain the growth, maintain the competitiveness, they need to reinvest. If a business model telling you never need to reinvest, or the investment capex is all incurred by the partners, how will be the growth profile going forward? This is your judgment call. Okay, just to give you a few thoughts. But these are all directly impacting your financial model. And I'll strongly suggest you should think about, discuss within team, like set up a table format. Okay, not necessarily putting all the quantitative numbers, but you should think about the discuss, and then leading to analysis and filling the form for yourself, whether you guys believe the margin trend going forward should increase or not, and the growth rate, how low would that be? And that will help the team members, also a small team within a big team, to work on the model. I've done mentors a few times. I have experienced that many cases at the end, because of all the homework, all the exams, at the end of the day, during the Christmas time, the gentleman or the lady who work on the financial model, he or she feeling alone, because the whole team have no conclusions. It's just he or she just do whatever himself. No, you guys should discuss way before he or she start the model. Obviously, the final number may not be exactly the same that you guys, the whole team, think about, but the trend he or she should follow and be consistent. Okay, this is how you think about the teamwork, right? Well, if anyone online, you have any questions, feel free to ask, stop me anytime you want. Okay, give you a little more thought about different valuation metrics, valuation approaches. And obviously, DCF is something like every team like to work on it. I would say I've never seen any teams throughout the last few years, competition have never worked on DCF model. Okay, this is all good. I mean, seriously, it doesn't mean DCF should be suitable for all the business. You can work on it, but the accuracy wise, or it's not totally or widely acceptable by the industry. In some cases, like banks or insurance firm, investors prefer price to book. And like say, sectors wise, which is very asset heavy, investors like to use the book value as a judgment as well. And also like some industry, which likely to be heavy, capital intensive, like commodities, sometimes even like loss making, they will trade based on a discounted price to book. Okay, But anyway, so different metrics will have different pros and cons. No right or wrong. Okay, you can build all the easy formula, but you just simply have to justify yourself. I just give you a summary of what I think to give you a thought. But I want to highlight to you is most of the industry, like hotel or internet or um, manufacturers, okay, PE is very commonly used. And I would say if it's a high growth company, P to growth is also important for you to think about as well. And we think about to growth, not necessarily just only 1 year growth. Some people use it, but I would say the best practice is 3 year growth rate. Okay, because you are trying to pitch to someone to invest in a little bit longer time horizon. Well, again, long term, the definition depend on investors, right? But you want to show at least you yourself wanted to show your projections to be a bit longer term. Okay, so the 3 year growth rate is reasonable, but the base year should be like 23, not 22. So the 3 year growth rate will be 23 all the way to 26. 1 to 3 years. Okay, got it. And you should justify yourself. And why you have to build a lot of what we call either the earnings based or cash flow based valuation approach, because you can easily to compare with peers. That's our ultimate purpose. And back to the point about when we work on, I mean, remember the first slide we talked about, you have to go through a lot of key questions about how the market position of the firm. A leader of the market should justify for a higher multiple. And just a smaller firm, maybe a niche player, depends, right? But likely to be a lower multiple. That's the way you think about it. Then you have to discuss within the team. Do you think they're a leader or just a normal firm or they're a niche firm? You can argue, okay? It's all your team approach. But you have to understand how the peers are trading. And some peers could be super big, the growth rate is lower, but because they have much wider network, should they deserve to enjoy a high multiple, even though um, their growth rate lower? So the PE will be divided by the growth rate and then become PEG. Okay. So these are some of the thoughts I want to share with you. And remember, some of the peers actually they pay dividend. And to some like investors nowadays, as you know, cost of capital has increased. That could be a big change as well. Even though the DCF could be very high, but from some investor perspective, because if those companies have never paid dividend or never distribute the free cash flow to shareholders in any form at all, likely that could be some discount to the valuation, because other firms, the peer group, can all show a line of dividend yield. Okay, and next page we share with you some of the formula. We won't go through everything, just give you a reference. But to some of you, could be very confusing. Would be what is the actual definition of the share count? Like market cap, you should use the basic number of shares, and likely or not, you may only get the weighted average shares, which is the share count across a quarter or across a year. But that could be different from the ending number of shares. Getting a little confused, right? Make sure your team, when you work on different kind of formula, make sure you use a consistent approach to calculate the numbers. And I would like to use, like say, market capitalization. If possible, I would like to use the end of the quarter share count rather than weighted average. And normally, the end of quarter share count could be found in the balance sheet. Okay, but when you talk about diluted number of shares, EPS, then you have to use the share count across a period. So that means if it is annual EPS, the numerator will be uh, the earnings will be across a year, and denominator also across a year. But then if it's a quarterly, then you have to use the quarter standard. Okay. So again, getting a little bit confused, but if you don't want to get into nitpicky, make sure you use a consistent approach. That should be still good enough. Okay. So I'll go through some of these numbers later on. So no need to worry. So we finished the first part, and we'll spend a little more time on DCF. And oh, it fixed. Yesterday, some of the formatting issues. I don't know why today is fixed though. It's good. Um, you may learn DCF to be discount cash flow to the equity, but the industry normally use discount cash flow to the firm. That means you have to subtract the debt and the cash. Add back the cash, subtract the debt before you get the equity number. Okay, so this is a formula. I don't repeat it, but we'll talk about. Well, I mean, later on we'll share with you more details about how you think about every single component. Let's say if you have discount cash flow, the first thing you think about is equity risk premium. And I would say a lot of students, even some professors, would likely to follow the NYU Stern School professor's approach. His name is called Aswad Marin, and he have written more than 10 different version book. Go to his website, you could get 3 copies or by the whole book or by chapters and even free PowerPoint, whatever, if you want to learn more. But give you a little more summarize what it thought. Okay, first of all, because this theory is, I'm sorry, it's from America. So the base case, the base equity premium is referring to only listed in the United States. And whatever kind of different kind of listing locations, you add back the country risk premium. If you want to get all these numbers by details, you can go to his website. He publish and update every half year. Okay. But normally I would say premium around 4 to 7% is okay. But this is all mainly US. Then you think about, oh, it's China, should add a little bit more. It's all fine. If you want to just simply simplify yourself, just go to wherever kind of website or Bloomberg, they show you equity risk premium listed in Hong Kong, want to quote, is all fine. But just to make sure you know what kind of concepts it. And by the way, when you talk about market risk premium, we based on CAPM model, and market is the primary and only risk. In fact, if you're a quant student, you may use multiple factor model, could be even more complicated. So this is not the case that we're going to discuss today, and not applicable to the competition as well. But remember, equity risk premium is something you guys should discuss before the colleague, the team member, work on the model. And beta, okay, once you know the market risk, and the beta is a measurement against the market, right? So you have, that's why you have to understand the business. You could have the beta of the whole industry, and vis-a-vis whether your target company has a higher risk business model or low risk than the peers, in particular the big guys. Okay, and for sure you can calculate your own beta. It's not too difficult. And online, you can easily find some of these, like, Excel spreadsheet you download by yourself as well. And for the same set of data points, because of calculation methodology, whether you are using arithmetic average or geometric average, you can come with very different beta. Okay, keep yourself simple. If you want to refer to from the beta from Bloomberg, this is all fine. But you have to understand how you measure the beta compared with peers. That's the key thing. And then the WACC, wage average cost of capital. Obviously, the key argument will be which risk-free rates should you choose. Some people argue this risk-free rates of China because the company is working, well, operating in China mainly. But I'll argue WACC is mostly referring to the cost of capital of myself. I'm an investor. This is my cost of capital, not the company cost of capital. For sure, that means if the company itself operate in China, they have different cost of capital, will be different from investors who have different set of cost of capital. So it's important to know whether you choose US or China. And back to the point, remember the a few pages before we talk about after you discuss the market growth rates, market terminal growth, then you should decide whether we should use 3 year, 5 year, or 10 years. Well, you can argue with 6 years or 8 years forecast period of the DCF model. Once you decided, your risk-free rate should tie with the forecast period. Think about you are investors. You have two choices: either to buy a company with 5 years high growth period and then in future stable growth, or you want to buy a bond. Then you ask questions. Oh, should I buy 3 years, 5 year, 10 years bond? Okay, that's the way you think about it. In the case of Aswolf, like spreadsheet, he like to use different year with different interest rate. I think that's too much. I would highly suggest you just simply use single risk-free rate across the whole period. Make your life easier. And obviously, terminal growth rates is important. The market size, market share, and as mentioned, like depend on your pitch and the storyline. That should be a range of percentage that I'm referring to the terminal value as a percentage of the total value, without counting the cash. Okay, so I would say 30 to 50% will be likely the range. Could be higher, or lower for sure. You justify yourself. But I want to highlight that you have to justify your terminal growth rate, terminal value, by dividing terminal value over the terminal earnings. Sorry. So what that means is the final year earnings times a certain growth rate will be that terminal earnings. And then the terminal value divided terminal earnings will be the terminal multiple. Would you develop a financial model, DCF model, that the terminal multiple be higher than the current year multiple or lower? Again, repeat the questions. You work on a DCF model, you have a current year earnings, that means you can have the current year multiple, okay, using the total equity value. Then you move on like 5 years or 10 years later on, you will achieve a terminal year, okay, and easy to calculate terminal earnings. And you get the terminal value as well. And divide the terminal value over terminal earnings, you get the terminal multiple. Would that multiple be lower or higher than current multiple? Any answers? Guess? Fine. Normally, I would suggest should be lower. The reason why you have to build a terminal value, because back to the point about industry cycle, you always have a high growth, well, initial high growth and mature phase, right? And you should assume after that mature phase, that should be the time that you build the terminal value. When you get a mature phase, I emphasize a few times, profitability could be growing slower. And that's why when you have lower growth rates, the PEG will lower, right? Should be lower. And that means that's the way to check and balance your DCF model. So your terminal multiple should be lower than current year. Okay. Yeah. So this is a quick overview about Aswolf work, and you can go to his website to check all these kind of like tables and chart. I don't try to repeat it, but you know, obviously for those who are a little bit new to finance, that could be a very good source of work. Oh, someone sent me a message. Oh, thanks, Monica. Sorry. Hopefully you can tell me your answers next time. Okay, it gives you a little more practical guidance how to define the DCF. So this is a quick example. So we come up with the firstly the EBIT, and then subtract the tax, and then add back all the other things. And then you got the free cash flow. So tax could be either tax paid or tax expenses. Different person will have different way of thought. The difference between tax expenses and tax paid, tax expenses are the tax number that you can find it in the P&L. Tax paid is the actual tax paid to the tax bureau in the cash flow statement. Normally are different, okay, because of the timing differences. And then share-based compensation expenses is a non-cash item. We'll discuss later on. Depreciation, you know it. Change in net working capital, you know it. And but also need to add back any dividends you can receive from joint venture, if because the company is changing its business model. Somehow, if there's any joint venture and generating profitability and potential dividend, it should be added back in the free cash flow. And obviously, don't forget about the capex as well. Oh, non-controlling interest. Maybe if we can record accounting clauses, it are something like, okay, you have a also kind of a joint venture company, but the other party is only a minority. Okay, so you consolidate your financial statement into your P&L, but you have to share back the profitability of that as subsidiary to the minority shareholders, as well as any potential dividend paid to them. Okay, so this is negative sign. Got it? So the sign plus the minus sign gives you the way to think about how this each of the item have an impact, what kind of impact to the free cash flow. So, oh, okay. Ah, okay. Let's give you a little more details of each of the item. So EBIT obviously will be without factoring into interest income and tax expenses, also without factoring the profit attributable to joint venture as well. Okay, but if they pay the dividend to minority shareholders, then you have to subtract those dividend underneath. Okay, and then tax, I'll give you more details. Um, and share-based compensation expenses, option incentive to employees, then we have to add back, and sometimes could be making a very big differences between the actual EBIT and your calculated EBIT. And then the two dividends from joint venture associate and on control interest. So you can read through it. I think the interesting item one to highlight is about the capex, because sometimes you could be very confused on this item. management and tell you, okay, I'm planning to spend X amount of capex the next 1 to 2 years time. This is a plan. And then in the cash flow statement, you find or change in uh, fixed assets, say for example, or change in PPE. But then going to the PPE, you will find another item could be different from cash flow statement. So I say it is very confusing, and it's very common because a lot of differences of the timing differences. You can build a building that you book the building cost already, but cash flow wise, because your suppliers, you still have like 3 months to pay back. Okay, so it will book in the other payables or trade payables, but not in the cash flow. So sometimes it could be very confusing. But no matter what, as time goes by, both items should tie, all the items should tie together, and you just make sure you use a certain approach to project. So obviously, like the case, if you're building a lot of new buildings going forward, you figure out, oh, the fixed asset increase much faster than the change of cash. That means in the future, when you project a cash flow statement, likely the change of the cash in cash flow statement, that means the cash-based capex will increase faster than your fixed assets. Okay, because they have accrued the assets already. Okay, so and the others could include a lot of impairment charges or disposable asset. Make sure you read through, and if if their statement quite clean, then maybe worry less about it. So after the free cash flow, then we have to move on to the net cash. As I say, the industry normally adopt a free cash flow to firm approach. So you discount the cash flow of everything, including both the equity holders and the bondholders. I mean, the equity holders share of the free cash flow and also the bondholders share of the free cash flow. Okay, but then you have to subtract the debt, but at the same time you have to add back the cash. That's the way to think about um, to build an actual equity value. And the way to define net cash is also a little bit hard, depending on how you argue. And next page we talk about it. And it is a analyst defined item. It's not a gap item at all. So sometimes some companies do define it, but you can also define something different if your team has different decision making. And also always like the net cash, you can calculate the net cash and see the trend, whether they're really accumulating or accumulating net cash or reducing from net debt to net cash. This is a way to assess the financial condition of the firm. So this is a summary of how to define the net cash. Okay, there could be a lot of different items, like say total cash. You can define something like restricted cash, and quite commonly appear in China firm P&L, sorry, financial statement, because they can deposit the RMB into China banks, and that could, and then they as a pledge, and then they can get US dollars from Hong Kong. And it's for the same bank. Okay, so then you guys can define yourself, but then a lot of these net cash company, they like to put a lot of extra cash, excess cash into financial assets. So I will also classify financial assets, which normally they may buy bonds or less risky securities that to enhance the value of the firm. Okay. Also on that side, there are different kind of bank borrowings, but also arguable will be convertible bonds. It's the equity related like bonds, like liabilities. Okay, and all depend on how you define it. Okay, if that's the case of CBE, obviously you have to argue whether once the share price exceed the conversion price, whether as a reasonable investors of the bonds, CB, would they convert it? Well, they can still have a choice not to convert it because, oh, I'm looking at it, it's only like a short term overshoots, fine, right? But if the share price above the CB for 10%, 20%, then it's getting difficult to argue, right? But I'm not sure whether this firm is CB, but then so the bond and debt, also there are a lot of different components. This is only a summary, but may not have include or the potential way of listing in the firm. But then normally you have to think about not all the liabilities should be classified as bond or debt. So we finished the real first part. Any questions? I just want to give me 5 seconds to drink some water. Okay, thank you. Thank you for the short break for me. And then you have to work on also financial analysis before you start the modeling. For those who have joined my first workshop, um, we actually have developed a financial report navigation guide. We're happy to share with you the PowerPoint as well. Then you can understand very quickly to understand the financial health of the firm. It's going through the financial statements, and you can easily identify a few key items for further analysis. Um, and this is important, but then we're happy to share the PowerPoint with you. And also you should do work on the ratio analysis as well. The lot that you can get it from textbook, right? Do you have to work on 10 or 20 ratio analysis? It's all up to you. But I would say there's a few which is definitely important. Um, and then you have to, well, after you work on ratios, definitely you have to look at the trend, the trajectory trend of the ratios, whether the margin is trending up or trending down. And back to the point, and you can still argue, is it only near-term trending up, or it could be long-term trending down. Okay, you have to think about how the trend will be going forward. And then obviously, after working all these ratios, it's very important again back to the peer group comparison. Okay, you don't have enough time, but once you go through all this discussion and analysis that we have mentioned in the last half an hour, you normally should understand and identify around 5 and most 10 key variables this company should have. Sorry, key ratio this company should have. Okay, so just focus on key ratios and see how the company positioned in it and how sustainable is this business model or not. And I will emphasize more about deal point analysis, which is also important for you to understand the trend. Earnings quality is more a qualitative type of analysis rather than quantitative, because um, you have to understand whether the management can deliver a sustainable earnings growth or not. In particular, okay, we have COVID. Okay, do you think they have respond and develop strategy to tackle the COVID well? That's the way to judge whether you think this is a good quality of management. And it's very important as to build a foundation to justify your future growth rate. And obviously risk analysis as well. We don't go through every single details, but just give you a little bit example about the formulas. And very important is deal point analysis. Obviously, from my perspective, this is important to understand how they leverage the balance sheet, manage the margin to grow the business. Okay. And obviously, you need to know how well the firm to control. And this is a typical approach that should work on. And some investment bank will enforce all the analysts work on deal point analysis as well, which is not difficult once your model completes. And for sure, the formula wise may not be the same. As you see, like there could be different moving parts. But I emphasize this would be a very good example for you to give yourself as a reference. Okay, so we pretty much have done the first two parts, and we have used around close to 1 hour. Okay, and then we will have another half an hour to go. I suggest we should have around 5 to 10 minutes break, and you can have